Hello, everyone. This is Ned Desmond from SOSV. So this is a very special breakout session with one of SOSV's favorite partners, Khosla Ventures, and this is entitled Raising Dollars and Building Multiple Climate Tech Companies. What can we learn from those who have actually done it? And leading the session is Rajesh Swaminathan from Khosla Ventures, and he's got a couple of very special guests. So with that, I'm just going to hand it over to Rajesh and go backstage myself and enjoy this tremendously interesting session. Thank you.
Thank you very much, Ned. Always a pleasure being on the SOSV platform. Usually I'm on the other side answering questions. This time, delighted to have two of our favorite founders join us and have the pleasure of asking them the questions. Maybe a quick background about myself, partner at Khosla Ventures, driving many of our climate investments, been investing in climate when it was Cleantech 1.0, when it is Climate 2.0, and there was a big period in between. Been doing this for 16 years now. Khosla Ventures itself is about a $17 billion assets under management. We have a seed fund, we have a main fund, we have a later stage fund. So we have the ability to write $2 to $8 million checks in our seed fund, kind of $8 to $30 million checks in our main fund, and about $50 to $75 million in our later stage fund. It's a $3 billion fund that we raised earlier this year. Before we jump into the details, maybe a little bit of a distinction between Cleantech 1.0 and Climate 2.0, so we are all on the same page on the lingo. Everybody has a different reference point. To us, Cleantech 1.0 is more like solar, biofuels, batteries, wind, which are all growing extremely fast. To people who question whether Cleantech 1.0 is real, it was absolutely real. There were 200 solar companies at one point. Many of them failed, but the solar did take off, and there were a few certain winners. Solar today has added more energy in 5 years than what liquefied natural gas did in about 30 years. EVs, as you all know, are taking off 18% of the global sales. Climate 2.0 we see is a little bit different. There are sectors like steel, cement, hydrogen, nuclear fusion, which are all emerging and other growth stories today. There is a significant amount of capital coming into clean tech and Climate 2.0. Over the last couple of years, there was a temporary pause, and hopefully things are picking up. Every election is on everyone's mind as well, but we'll get through all of that stuff. Today, we have two great speakers, Ryan and Pete. They have built multiple successful companies between Climate 1.0 and 2.0, and even now, they're building some great companies. Ryan just opened the first decarbonized cement plant. Very excited to have him in our portfolio. He's built multiple companies for us. Pete just raised over $250 million. Every time I talk to him, every few weeks, that number keeps increasing. So I don't know what the latest number for him is. He's been building his third company called Koloma that my colleague Jesse invested in. Without much ado, let me pass it on to these guys. These guys have been through lots of ups and downs in the clean tech journey. There is a lot of learnings for all of us from what they have gone through. One thing we want to keep doing it is we want it to be an interactive session in the sense of not interrupting the conversation, but really want to keep adding some resources as we go through the discussion. No need to look at the resources during the discussion, save them somewhere, but continue to look at it. So this is not just one another panel where we're just chatting about it. We really want you to get some takeaways, things that you can read up, reflect on even after the panel conversation. Quickly jumping to you guys. Ryan, maybe a quick introduction about yourself.
Yeah, sure. And Rajesh, obviously looking forward to the discussion today. So myself, Ryan Gilliam, so CEO and co-founder of Fortera, and we're a company focused on paving the way to zero CO2 cement. I'm sure we'll get in a lot more detail as we go through, but 17 years into the climate journey now, from Climate 1.0 into 2.0. And so I'd say, a lot of what we'll be talking about today, in my view, is just what's really needed to get to be successful in this Climate Tech 2.0. And so looking forward to that discussion.
Yeah. Hi, all. Nice to be on. Good to see everybody. Ryan, Rajesh, good to see you guys. I'm Pete Johnson. I'm the CEO of Koloma. Koloma is a geologic hydrogen exploration company focused on sort of deploying our data and our tech advantages to go find what we expect and what we hope to be the world's first new primary energy source since nuclear power in the 40s. We've tapped into a bunch of data sets and have been actively finding hydrogen resources under the ground. And if that sounds crazy to you, it sounded crazy to me 3 years ago before I jumped into this, but it turns out that the Earth has been producing a huge amount of hydrogen over the past millions of years, and we're looking for places where the Earth both produced it and trapped it and accumulated it. So,
thanks, Pete. Picking on what you mentioned, crazy, you actually have built companies around three crazy ideas, or you've been part of three crazy ideas. You were the first engineer in our solar thermal company, Ostra. This is 15 years ago kind of number. And when most people are doing solar PV, you are doing solar thermal. And then your second company, Monolith, you're part of the co-founding team. It has raised $1 billion in DOE loans. You're doing methane pyrolysis when nobody cared about methane. Now you're doing geological hydrogen. I look at it as anybody looking at building a company in climate is crazy. To build 3 companies is even more crazier. And to build 3 in 3 areas that most people are not looking into is even more crazy. So give me a sense for, what drives you to go after such offbeat, high risk opportunities in climate? How did your past prepare you for this? How should entrepreneurs think about it?
Might have just been that I couldn't get a job working in any of the more standard industries. I mean, who knows? But I mean, look. In general, I'm a big fan of doing the math and focusing on impact and opportunity, right? And so, if you do the techno-economics and you see that there's a really high margin available, and you do the work and you figure out, hey, that's going to be really impactful if we can change that industry or do this. That combination of high margin and high impact, I think, are really interesting. I decided 20 years ago in my career I wanted to focus on things that were going to really reduce CO2 and impact the environment. And so some of this stuff's just being opportunistic. I'm a huge proponent of the book Drawdown, where they look at the most cash effective ways to impact CO2. And I mean, some of the ideas in there are even far crazier than the things I'm working on, like figuring out how to extend peat bog's life in Ireland, but there are ways that we can impact CO2 that are off the beaten path, but really impactful and really profitable. And so I've just kind of been following the map on geologic hydrogen. I mean, when this idea first got floated to me, I thought it was nuts. And then I started reading papers and doing the math and realizing, okay, there's not really a debate that the Earth produces a huge amount of hydrogen. We can trap helium, so we know that we can trap molecules that are smaller than hydrogen. So the Earth should have the physical capability to trap that gas. We know it produces. Can we utilize oil and gas technology to go out and confidently explore for it? And that's a big swing, and it's a big question. But I mean, is the impact of this one that was just intoxicating to me. And once I started thinking about, well, what happens if you can find large volumes of carbon-free fuel under the ground, and how does that impact all of these downstream derivative industries that we're trying to decarbonize? When you start thinking about that, you can't really put it down. And that's kind of my thing, is if you do the math and you see the impact there and the margins are high enough, it's probably worth starting a business. And it's not always easy to go raise money for something that's off the path because, right? I mean, a lot of people don't understand it. When I was raising money for Monolith doing methane pyrolysis, there's 5 or 6 methane pyrolysis businesses going on now, and I think people get it. When I was raising money for it, it was like everybody wanted to argue with me over whether the shale boom was real or whether it was just speculation. And that wasn't if you didn't believe that natural gas prices had a major dislocation, you weren't going to invest in Monolith. And we quickly learned to just leave the room and leave halfway through a pitch if that was the debate. So you're not going to be everybody's cup of tea if you're not doing the hot thing, but it's worked out.
Great. Maybe I'll put it, you mentioned something about impact. I'll add in a resource on, a paper we put in, Vinod wrote in 2020 that talked about what are the a dozen entrepreneurs that will change the world. Impact is probably the most critical one that we look at. There are 12 ways to change the world. It includes things like nuclear fusion, geothermal, hydrogen, cement, steel. So the magnitude of the effort the entrepreneurs in the industry need to go after needs to be huge to make a meaningful difference. And that's how, many of the, VCs working with us and, co-investing in the space do look at it as well. So incremental doesn't cut it. And that impact is probably a big driver for many of you. Ryan, going on to you, you've been, your background has been electrochemistry. You co-founded 3 companies with us, at least 3 to the effect I know. What drives you to build these multiple successful technologies into big businesses? And you're a CEO of one of the companies, but you're on the board of the other companies. Give us a sense for what does it mean to be on the entrepreneurial shoes?
Yeah, and I would say I think there's probably a lot of parallels to what Pete just said. I think, frankly, I got into climate tech maybe a little bit naively. So going back this 17 years, I was in grad school working on green energy in the hydrogen space. Right at the time, Inconvenient Truth came out, and so kind of doubled down on my conviction that climate tech was important and we needed to focus on it. And so while I was planning to go the academic route, I got lured to come out to Silicon Valley, join a startup company. And it was in those times where, you had companies pitching these incredibly cool technical ideas that would really going to change the world. And so that got me inspired to jump all into it. I'd say it wasn't long into that where kind of Pete's conversation on economics matter, really came to the realization that, yes, I was part of a company that had a cool technology, but I started forming that thesis that if you really want to be, successful in scaling these technologies, and success to me means actually addressing gigatons of CO2, it really is going to come down to the economics and scalability. And so started forming a really hardened thesis around that. And so the companies I've been a part of now, and Fortera especially, in terms of our thesis, it's, already had conviction on the importance of climate tech, grew conviction that there is a right way to do it when you focus on economics and scalability, and so you can be successful in doing that and having a meaningful impact. So that's really what I'd say was the motivation in starting these companies. But, and I'm sure we're going to get this later in the talk, but the other big motivational piece that I don't want to, not mention here is that at the end of the day, when you're working in climate tech and for mission-driven companies, I've had the privilege of working with just absolutely incredible colleagues who are, driven by the mission, passionate about what we're doing, put in those long hours. And anybody who's gone through climate tech, or frankly, any startup company, knows the roller coaster that it is. And so having that, people willing to persevere through that, that's, it's inspirational to be part of that type of journey. And I've been with multiple of these employees for multiple companies now. So it's hard not to be motivated with that.
We'll get some specific lessons from you in the conversation. Why do you think Climate 2.0 will be successful this time? Maybe Pete, you can take a stab.
Yeah, I mean, I bet you Ryan and I are going to steal each other's thunder because we carry the same scars on our back. I think there's more discipline in the investing world. I actually think you have some quality by choice, and some of the things that I think we're getting funded in Climate Tech 1.0 just wouldn't have a chance at all to get capital now. Like I think some of the things that investors learned was that experience matters. And I think that people are looking for executives who it's not their first rodeo. I mean, sometimes there's always that diamond in the rough who comes, right out of grad school and can figure out things that nobody has, but there's more of an emphasis on experience. I think there's more willingness among, companies like what Ryan and I are doing to partner with big existing incumbent players, and particularly some of the players that I think are kind of villainized sometimes unfairly, which are like oil and gas companies and others, and mining companies who I think want to be part of the solution. They also have shareholders, and they're trying to run this balance where they're trying to find a bridge. And so I think there's more willingness to partner. And honestly, like those big mining and oil and gas companies, those are the best infrastructure companies in the world. And they are so good at what they do. And shutting them all out and thinking, hey, I'm going to go this way and then I'm going to take over the energy world with them. That there was a little bit of hubris, I think, in Cleantech 1.0 that might happen. And I think that's really gone. I think a lot of the hubris got stamped out, not all of it. I'm sure there's plenty of places. The last thing that I think is really interesting is that Cleantech 2.0 has a broader focus, right? I mean, we're talking about cement. We're talking about lithium extraction from petrobrines. We're talking like it has like a resource focus and industry focus where I think we're really being thoughtful about pursuing the lowest hanging fruit in places. And there's a little bit of less of an idealistic push and more of a, hey, let's improve, let's get to net zero, not get to carbon zero, let's get to net zero. And I think all those things will lead to better opportunities, more maturity, more wisdom in picking them. Look, there's still going to be hits and misses. I mean, we know that climate tech's tough, like energy infrastructure is tough, but I do think there's just more discipline and more wisdom right now.
No, I agree with all the points you made. One thing I do want to comment, you said investors have learned a lot from Cleantech 1.0, which is very true. But it surprises me that 95% of the investors who are in Cleantech 1.0 haven't come back into climate.
Yeah.
So something that
there's
we
a few. There's a few who stuck it out.
Continue to learn from the lessons we have all learned. So that's very, very important. Ryan, why do you think Climate 2.0 will be successful this time?
Look, I mean, Peace mentioned a lot of the important things. I think kind of like when I talked about why I, was motivated in the space, that same naivety I had going into climate tech, I think also just was there in Climate Tech 1.0. And so we had to go through that learning curve to understand, the actual economics around these and actually the time scales around building businesses. for the most part, when we're talking climate tech, we're talking, high capital, low margin industries where economies of scale really matter. And so I think the industry now is just much more aware of how long it actually takes to get through a demonstration plant and how long it takes to get through, first of a kind through to nth of a kind plants. So I think there's just a more of an appreciation of what it takes to build a company now by a lot of these investors. Pete mentioned this, but I think from the incumbent perspective, 15 years ago, I spent a lot of time traveling, trying to meet with the big chemical materials companies, getting them interested in what we were doing. And whether it's them having woken up to the issue around climate tech or frankly just societal push, I see all the incumbents are at the table willing to test and try things now. So I think that's a very different space for entrepreneurs to actually work with these big companies that really understand scalability and economics. And I'd say the last piece that I think is fundamentally different is, and I'm sure we're going to talk about this as well later, but this whole idea of first of a kind valley of death, it's real in bringing these techs forward. And I'd say in Climate Tech 1.0, it maybe just wasn't completely appreciated, those timelines and costs to get to the first of a kind. But now there's actually funding mechanisms in place to help people get through first of a kind as well as get past first of a kind. And I don't think that same opportunity existed back in Climate Tech 1.0, or at least not to the same extent.
Sure. So I want to jump into the overall financing, but there was a reason to address some of these questions. Unless it's a very huge impact, the finance and fundraising is not going to be easy for good investors. So the covering that impact part was good. Unless we all have learned the lessons from Cleantech 1.0 and not do the same mistake, we'll still do mistakes, but hopefully not the same mistakes. That increases the chances for successful fundraising in any environment. I think the third one that we really, really care about is what kind of asymmetric advantage can climate startups have when you enter into existing kind of commodity industries. At least from a Khosla Ventures perspective, this is something we care a lot about, and it's very, very helpful to think through this a little bit from your eyes as well. So when we were thinking about nuclear fusion, in fact, nobody was investing in that space 6-8 years ago when we were investing in Commonwealth fusion. The way we were thinking about it was, how do you replace the coal boiler in an existing coal plant with a nuclear fusion system? It's a very different way of thinking about every industry. It's not something we should say for the sake of saying it, but think about it. Like, you have coal plant in an existing county, and people don't want that to go away. You actually don't need to take it away. There are a lot of advantages in having a coal plant. The balance of the plant to a nuclear fusion boiler is very similar to what you need and what you have in a coal plant. The permitting is done. The overall jobs are right there. Electricity generation is there. Transmission is there. So if you look at every industry from that perspective of how do I work with existing incumbents to replace something they have or add something to what they have, that just increases the probability of success, reduces the overall time to market, and increases the political support that's needed for many of these industries to happen as well. But you guys have some good examples. Maybe Ryan, talk a little bit about, and that's been instrumental to the success of Fortera as well, compared to a lot of other cement approaches where people have looked at new materials and a lot of new stuff. Yours is a very disruptive technology, not to take away from it. Like, it cannot be incremental because then it's not a venture investable opportunity. It has to be significantly disruptive, differentiated. But if you can find a way to partner with existing players, that makes a big difference. Maybe talk a little bit about that.
Yeah, I mean, look, the thesis you just gave is really the thesis that we had at Fortera that gave us conviction to start the company. I say that, again, when you're looking at these high capex, low margin industries, like cement is so maybe just to help with the cement context, cement's the glue in concrete. Concrete's the second most consumed thing on earth behind water, right? So concrete's 30 billion tons a year production. You start getting down to other metals like copper's 20 million tons. So this is just a huge, huge market relatively. So if you define success as actually trying to solve for CO2 in that space, what you're inherently taking on is you need to be able to get to the scalability to match that 4 billion tons of cement, 30 billion tons of concrete that's produced a year. And I think that the fundamental challenge is, a lot of times, and I'm guilty of this as well in the early days of startups, is a lot of people have this comfort in complexity. The cooler the technology, the cooler the idea, the more you get, want to get involved and get into it in the lab. But at the end of the day, if success is getting to gigatons, scalability has to be there. And the only way I see scalability happening, especially in a place like cement, is actually working with incumbents. They understand how to grow to large plants well. They understand how to push down capital costs and operating costs really well. They understand the logistics side piece of it. And so at Fortera, we are partnering with the cement plants We're using the same feedstocks they already use, which means it's already at that 4 billion ton a year mark in the cement world. We're leveraging as much of their capital infrastructure as we possibly can, because I think by doing so, you're really competing, you're bringing your new product to market with plants that already exist. So your CapEx and OpEx has to be competitive with just their ongoing OpEx. So by leveraging their infrastructure, their capital infrastructure, you can drive down costs. So it really is learning from the incumbents what they do well that allows you to get through that scalability. And I'd say the last piece of it too is, for us in designing our technology, we've done a lot to really try and simplify it. If you can leverage existing process units, existing equipment that's already proven at scale, this already has a supply chain in place, again, it helps with the timelines to scalability and reducing costs.
And Ryan, in your case, you're integrating into existing cement plant. You're actually absorbing the CO2 into your calcium oxide, and therefore you're actually increasing the throughput of an existing cement plant by 44%. So you're not only capturing the CO2, you're using the exact feedstock, and the economics of the cement plant is even better. So that's like a perfect case of why you can get into any existing cement plant today and make it differentiated.
Well, and I say with what Pete said at the beginning with economics matter, I probably should have said, when it comes to economics, I think, again, if you want to get to these billion-ton scale, you need to be able to compete without a premium on green. There are for sure people that are going to pay for premium on green. There's sure going to be incentives in place to help for early adoption. But if you want to get to that meaningful scale and get to the gigatons of CO2, you're going to have to compete without that green premium. And that's by partnering with the incumbents and actually turning that CO2 back into product and creating value out of it. That's how we do it.
Pete, what's your asymmetric advantage?
Well, I mean, it's a little different. We're working in a brand new area, brand new field, right? We're exploring for a resource that 5 years ago nobody was talking about. I was skeptical coming into this. I heard about it. I couldn't put the idea down because I thought I was thinking about impact. When I was introduced to my co-founder, a guy named Tom Dara, who's a PhD in geochemistry, a tenured professor at Ohio State, and Tom had spent 20 years sort of coming up the academic track, and he had been running a commercial lab in parallel with this. It was basically, it became the global leader for measuring oddball hydrogen gas samples. And he was studying hydrogen samples from people all over the world for 20 years. And he developed technology and tools to be able to determine how old gas was, how deep it was formed. So by the time I met Tom had 30,000 gas samples in his database and hydrogen samples from every continent, and had basically the top 70 regions in the world already high graded, where you had both gas measurements and gas samples of 80, 90% hydrogen downhole, plus all the other kind of systems you need to both store and trap gas there. So the asymmetric advantage for us was that we had 20 years of data generated from 500 wells that accidentally hit high hydrogen. And to go out and drill 500 wells to go like mimic that data, I mean, that would cost you $2.5 billion, right? So massive data advantage. And today, right, a data advantage is different than a data advantage 30 years ago. With all the tools we have in AI and machine learning, you can take a data advantage and you can actually make it like pouring lighter fluid on a fire, where you can then build tools and powerful analytical tools using that data advantage to not slowly get caught up to by others, but to build an even bigger lead. And so we use that data advantage as both sort of a treasure map for where we should first start looking in earnest and drilling wells, but also as a training data set for building a bunch of additional tools.
Yeah, in some ways, it reminds me of opportunity meets preparedness. In the case of Ryan, in the case of Fortera, the preparedness is the existing CapEx facility. And this is an opportunistic way to change many of the stuff. In your case, the preparedness is more about existing data. So neither of you are like forcing a new technology for the sake of technology to happen. But there is a lot of background work that has happened in terms of whether this is the right way to commercialize. How did you de-risk it even before you started raising the money, both from an overall strategic planning perspective, long-term, as well as when you're executing it with the right partners and so on. Is that a fair way to look at it?
Sure, I like that.
Yeah, and Rajesh, I mean, the story for us, but when it comes to Fortera, we frankly, the luck we had is we're only a 4-year-old company, but we're 17 years in the making. So the technology that we built off of started 17 years ago in Climatech 1.0, very successful technology. I mean, we put 100,000 hours of R&D, 100 plus patents, 5 years of piloting work, put material into real world applications. Unfortunately, it was during Climatech 1.0 where we weren't grounded in economics. So be able to apply the thesis we had and be able to build off of something that was already proven out allowed us to go to scale really fast.
Well put. We'll jump into equity fundraising, which is probably the most critical one. You guys have funded these companies during very, very tough times. Like, what worked during bad times? What worked during good times, post IRA, in securing the capital? Little bit of lessons, hard lessons that can be very valuable for everyone. The climate will always, in my view, continue to have these ups and downs. Unfortunately, in US, it's related to political, elections and a bunch of other things. But it's good to know what helped you get through that gap. Maybe Ryan?
Yeah, sure. Yes, it's been an interesting road looking at funding over the years. I should probably start off not trying to give a necessarily Khosla Ventures shout out, but I mean, obviously the important thing was having good investors behind us that believed in the vision and support us through the way and helped us kind of navigate all that, which is why I've been obviously involved with Khosla Ventures through multiple companies now. But I would say the hard part is going through the funding phase. It's been, it's gone through its cycles, and we saw a few years ago a new big push in climate tech again, which is great for the industry and great for new investors. But early on funding, when you're seed stage Series A, I think there's a lot of opportunities and different groups that are out there. The hard part to me on funding is as you go further and further into the development, as the timelines for development, inevitably get longer because doing demo plans and commercial plans take time. Finding the right buckets of funding that can actually help you get to those longer time development timeframes and higher capital requirements to me is where the challenge is. And I'd say that over the years we went from, I'd say, an early climate tech, not wanting to necessarily work with the incumbents or strategic investors, to really realizing that they actually can help with credibility. They can help actually with scaling the technology. And they also, over the years, we went from more venture style investment to actually bringing in strategics into the equation. And so even at Fortera early on, we brought in, one of the biggest construction, chemical, and the cement concrete space in as an investor. We brought in a strategic that will help us roll out the portfolio in Asia, which is 70% of the market. So, I think just getting the right mix now is important to bring enough people to the table that they can see your vision and can help you through each stage of the company.
And Pete, what made you successful in fundraising for Koloma? You said it's a idea, high risk.
Look, I got thrown out of most investor offices that I went into, and luckily it's mostly over Zoom these days, so it's more just somebody who's clicking a red button. But I mean, I like to point this out to people, which is, as a entrepreneur who needs other people's money to build the company you need to build, right? There's plenty of entrepreneurs who open restaurants with their own money, and they're great entrepreneurs too. But a lot of us in clean tech, we can't do it with our own money. You've got to go do this with other people's money, and you got to get people to take risk alongside you. You're ultimately going to sell a bunch of different things, but the first product you ever sell is a share in your company. I mean, unless you're lucky enough to get revenue first, but generally the first product you ever sell are seed shares. And the last product you ever sell in a successful venture company are shares. And in between, you're going to sell a bunch of other products, hopefully some cement or some hydrogen or some electrons or some equipment. But your first and your last sale will be shares. And you have to know your customer. You have to look at your investors the same way you would look at your customers. You have to understand what drives them. What do they need? What do they need to see in a business? You obviously don't want to build your business just to check boxes for investors. You want to build your business to be successful, but you should understand how investors think about risk and how they think about portfolios, and understand where you would fit in a portfolio. So an example, like geologic hydrogen, crazy amount of risk, crazy risk, right? It's crazy enough to go explore for oil and gas, and we know where all the oil and gas is. We just don't know exactly where to drill wells. It's crazy risk to go explore for a resource that nobody believes exists, taking on oil and gas exploration risk, but looking in totally different areas that are undrilled. At the same point, there's this massive asymmetric return if you find a geologic hydrogen accumulation that normally in a clean tech investment, it's 10 years of wrestling with a machine to get it to work, and a successful outcome might be a 3 to 5x return. In a geologic hydrogen play, it's more risky, but your return is a 50x. It's just giant return potential. And so replacing that and being honest and open about the risk and the upside, and realizing how your customers who are buying your shares are going to think about that in their portfolio. Just a really important thing. So then when you go into a fundraise, you don't think of it like a fundraise, you think about it as product sales, and you know your customer, you lay out a pipeline, you do everything the way you would do in sales. And I think just being really disciplined about the process you run and how you characterize your first and your last product, which is shares, it helps. I mean, there's no magic bullet, and sometimes you've got the best idea in the world and it's hard to communicate it or people don't believe it. But I just think discipline, communication, being realistic about risk and upside, that's sort of the advice. I also think fundraising in clean tech is kind of like being in the oil and gas industry, where in oil and gas, there's this commodity cycle, and oftentimes the best entrepreneurs don't necessarily win. It's the people who came in and out at the right time of the commodity cycle. Clean tech funding is a little bit like that. And right now we're in a little bit of a dip. And so you got to batten down the hatches and make it through.
Yeah. Speaking of fundraising, I promised to put some resources in. I'll put some resources from KV, our friends at EIP and Breakthrough and all that stuff. So I think one of the ones you talked about is pitching. There's a really cool video. I've always been impressed by this one from Vinod in terms of how do you pitch to VCs, catering to what they are looking for, and how do you build the credibility and how do you communicate the story and all that stuff. It's a really good video for anybody who wants to look at it later, not in the middle of the session. We talked about equity fundraising. The other big part for clean tech companies is certainly DOE and folk, the first of a kind plan kind of fundraising. Ryan, you're going through the DOE fundraising, but talk about your first of a kind plan fundraising. What are some key takeaways? What were your learnings? And what are some things that we should take away while preparing for first of a kind?
Yeah, I mean, so this is a little bit specific probably to the company and how expensive that first of a kind is. But I would say, Pete's comment about knowing your customer is really important. For us, for example, when we went to the first of a kind plant that we opened up earlier this year, in the cement space, you have to get to incredible economies of scale to really be economically competitive, right? You almost need the same number of operators running a 10,000 ton per year plant as you do a 1,000,000 ton a year plant. And so for us, what that really meant was we were going to build a first of a kind plant that we knew wasn't going to pay back its capital. So this is equity dollars that we would need to put to work to prove the scalability of the technology, to get people then comfortable to partner in and build much larger commercial plants. But because of the economies of scale in cement, that was not a small cost associated with that first of a kind, right? And so when you go out and look for what are your funding buckets that are available to make that happen, I think there's a general view that you would go after kind of project finance, infrastructure growth funds. And so you just need to put where you're actually at in development, where you're actually at in risk relative to those different funding buckets. And so for us, for the first of a kind, being it was a plant that was not going to be economic from a perspective of paying back that capital, it really meant that we had to focus on getting enough corporate equity in to pay for that first of a kind plant. And that means getting the right investors at the table that saw the vision, saw why once we got that first of a kind plant, we could unlock a commercial pipeline and a pathway to really growing the business. And so that's really, we had to have that messaging right and get the right backers behind it. I think it is incredible right now, and there are first of a kind funding groups that are out there that are willing to take more risk on those first plants with that view to pipeline of putting project finance dollars to work on commercial plants. So I think there's more opportunities now, but you just need to match up how much funding you need and the timelines with the different types of funding groups and what their risk profiles are.
Pete, anything you want to share? You just your last company, Monolith. I think after you started Koloma, they were able to get $1 billion in DOE loan. What lessons for others as people think through these kind of DOE loans and larger fundraising? Non-equity fundraising.
That DOE loan guarantee, we got that while I was in the board of Monolith, but my co-founder was really leading the charge on that. I mean, I think the lesson learned on DOE loan guarantees is those are really helpful, and it's a cheaper source of capital. It's not an easier source of capital. It's a lot of work on that, and it's not like you get to skip any steps or you get to waive off any risk. The government has hired really smart people and former bankers and former like credit fund operators to run that. So I mean, there's no get out of jail free card. I'd come back to what Ryan said, and there's a friend of mine named John Cousins, who's this really smart CEO as well, who says the same thing. Look, one of the things that I think people have realized is you got to have sort of 5 shovel-ready projects, and then get somebody to take first of its kind risk on the first one, with a right to go and to fund the other 4, some kind of a ROFR or something like that. You've got to find something to sweeten the first of a kind. This concept, hey, I'm going to go out and get cheaper project finance to fund a first of a kind, it's silly. Like, nobody's going to do that. You wouldn't do that, right? So you've got to go find some sweeter thing, and it might be some top co equity or warrants or this, and it generally is both. But and I think the people who write those bigger checks are onto that, and they're recognizing that there is value they can create by some agreement to fund an armada in the development pipeline, and they can monetize that. You've got to find some other way to bring them to the table.
Sure. I'm going to add a resource. I don't know how exactly this chat is working. We'll find out. I'll keep adding some resources. Hopefully, all of you can see it. If not, we'll cut and paste it towards the end. There's a good article Breakthrough Energy Catalyst team has put together. They're very good in looking at first-of-a-kind plants. They talk about the 12 steps you need to think through when you approach the first-of-a-kind plants. So some of you may have looked at it. Others should take a look at it and try to understand. And even if you're a seed or Series A, Series B company, you have to be looking at what is needed for the first of a kind plant, 3-5 years down the line. Because we have a seed fund, we have a main fund and a later stage fund, we are extremely disciplined to look at what will take you there. So we can even invest out of our main fund and the later stage fund. So we have the discipline of looking at it. It'll be great for founders to continue to see, what are the requirements? Because at the end of the day, you're trying to build a successful business that's going to build a plant, that's going to go through a great IPO or potential exit through an acquisition. But to get there, you need to think 10 steps backward and take it from there.
Yeah, and Rajesh, if I can just add on that, I mean, just back to the comment I made about your shares as a product, what I find really gives you direction as a company is you should lay out what an ideal data room will look like for the people who are going to invest in that project. And you should lay it out 3 years in advance. And so that can kind of be your North Star of what do we need to be doing right now, so that we have a really great data room that people are going to be going through as they're determining what they're willing to invest and pay for that right to be in the first of a kind. Like, data rooms can be your North Star. That's like your product, right, for raising the next round.
So brings us to a more basic question. When IRA came in 21, we got a lot of pitch decks, very passionate entrepreneurs who wanted to build the climate companies, get to scale in the next 3 to 4 years. Very ambitious, great. But Ryan, maybe take us through, why does it take 5, 7, 10 years to build these climate companies? Just walk us through the journey from lab to pilot to commercial to, significant scale up.
Yeah.
Press the timeline.
Yeah. So, I mean, I think that was the thing that we all went through a learning curve in this climate tech cycle, right? It's, when you get in and you start thinking, and I should say, I think a lot of people are understand this better now, but I still see pitches regularly where people think within a year they're going to get to, scale that plant. The reality is after you've proven stuff out in the lab, you've been able to then successfully raise a big enough round to go to your first pilot or smaller type demonstration plant. There's a reality in, after you have permits, and I don't want to ever underestimate, it depends how big you're going, but permits can be a big challenge to get in a lot of these spaces. But after you have your permits, you still need to go through your feedback, so basically your detailed engineering work. And that realistically, especially if it's any appreciable size plant, that's minimum 6 months, probably more 9 months or longer to get through that. It's not until you have that type of feed package done that you can really start buying long lead equipment. And yes, you could put money at risk and start buying earlier, but a lot of times long lead equipment, especially post-COVID supply chain world, can be a year or longer lead time to get that equipment in. And then you have the whole construction phase of building that out. And I say you should never downplay, I mean, we all do, but you shouldn't downplay how long it takes to get through the commissioning phase, especially if you're bringing a new type of tech that's never been done before. So by the time you add that all up, you're really talking kind of 3-year cycles to go from lab to pilot, and then probably another 3-year cycle or more, again, go from there to demo, and then from there to commercial. And that's provided the permits and everything else happen smoothly. And so those can all just be adders on that timeline. And I think that's one of the hard parts of funding these, is that if you're going for that first of a kind, you're not only trying to raise the capital to build that first of a kind, but you need also to be able to build out the team to be successful in executing on it, as well as that 3 years worth of burn to get there. And that's fundamentally why there's such a big leap between idea and lab testing and scale up.
Very helpful. You guys touched upon strategic partnership. That's a critical element. Maybe give us 2 or 3 examples on how exactly do you work with a strategic partner. This happened in Cleantech 1.0, not very successfully, happening in Climate 2.0. I've been a strategic VC myself for 10 years. Before I switched to financial, been with Khosla Ventures now for about 5 years. So there is a right way to do things, there is a wrong way to do things. What are the best practices for working with strategic partners? Ryan?
Sure. I think, a lot of people when you're early on into a company, you avoid strategics because you're worried about, are they going to take your IP, or how's this going to look? Or frankly, because they're a much bigger company, they have a lot more leverage in negotiations. So you do have to get it right in forming these relationships with strategics. But I mean, one of our core values as a company is think customer. And I just fundamentally believe that if you're going to have a meaningful impact in, again, these high CapEx, low margin spaces, you have to get the incumbents interested in your tech and working with you to roll it out. And that means engage them early on into the process. So as long as you can get your IP covered and you feel comfortable in doing it, which I think, again, don't want to downplay, that's important to get that right. But then getting your product into their hands early in the process, getting them to test it, getting that feedback loop, started so you can iterate on the product, make it better, make sure you're actually developing something that they actually care about at the end of the day. Never would downplay how important that is. And us in doing that, we've been successful in bringing some of those partners now in as investors into the company. They saw what we're trying to do, and now they're, helping us actually expand beyond the US into other regions of the world. So I think my view on the strategics is they're helpful to validate that what you're doing matters. They're helpful to give you feedback on how to develop your product and do it in the right way so that you can be successful at making something that they'll actually care to implement. And at the end of the day, these companies are successful and big because they really understand scalability and economics and global rollout. And so then leveraging that to make that happen is just as important.
Yeah, and I just take another example, Ryan. Maybe you co-founded Verdagy, the green hydrogen company that went from lab to pilot to now building a gigafactory within the last 4 years. Folks like TDK Ventures, Shell Ventures have been great partners, and we've structured a syndicate. So there is a very specific way each one of them is working together. The company, Shell has been a great partner on doing an MOU, testing their facility, giving a lot of credibility to what they're doing and taking them to the next stage. So it's about structuring it well, working with your existing strategics and existing financials to bring the right people to the syndicate. So you bring in strategics who can add a lot of value versus analysis paralysis. So there is a fine balance one needs to strike. Pete, any thoughts on how you've been thinking about it?
Yeah, look, I think you got to think about strategics in 3 buckets. There's like the strategics who would want to buy your product, right? And like Ryan said, you want to engage with them as
Pete, as in your definition of product is shares or hydrogen?
No, I'm on to the I'm beyond. Otherwise, everybody's a strategic. No, you want to engage with strategics as fast as you can. You'd want to buy your product, right? Because that's how you're gonna get that market feedback and build a real company. So, and bringing them in as investors, I think just aligns everybody. So we have Amazon and United Airlines, both of whom, which for geologic hydrogen would be a huge impact, for their whole, carbon neutral or net zero plans. And then you got the other bucket, which is sort of the strategics who would want to supply services to help you, sort of the make or buy question of, do we need to invent everything, or could we build some kind of a strategic relationship with this group who could help us strategically do this one function better or that better? And then there's the groups that, you could envision you're selling your company to, who are sort of competitors, but might also be collaborators. And for us, like the example of that would be like the IOCs, like the Chevrons, the Shells. And those are the ones that you got to be a little careful with, because you don't want to give them the milk without making them buy the cow. But at the same point, you got to realize, it's really hard to build clean tech companies on your own. And most of these guys want to partner and they want to learn a little bit. And that's actually going to help lead to acquisitions down the road. So I think that's another difference. I think 20 years ago, people had this, we can do it all ourselves and keep everybody out of it. And then boom, suddenly go to market and 10 people are going to be bidding for this company. The reality is it takes so long that there's this diffusion of knowledge. Anything that my view is engaging with all of them as early as you can is great. I think you have to be very careful with the last bucket to make sure you don't push your know-how and your IP out too far to the point that you erode your ability to negotiate an exit down the road.
That's helpful. So one key element of the whole fundraising is how good is your team, right? At the end of the day, at seed stage, Series A, even Series B, the team is what investors are betting on in a big way. We look at it as a team you build, as a company you build. I spend most of my time actually recruiting for my companies, whether it's the VP of engineering, CTO, and sometimes CEO candidates. And that takes up a lot of time. In fact, Vinod calls himself a glorified recruiter. So this is an important aspect. Like, how do you guys think about, and you are in industries where you might be attracting people from completely different industries. In fact, we wrote an article with the whole concept of gene pool engineering. That's a very interesting concept as to how do you look at the risk in a company that you're building? What are the key risks you want to retire over the next 3-5 years? What are the centers of excellence you should be targeting to attract people from, and how do you go and get them? So folks can read that article another time. But Ryan, maybe talk a little bit. I've just posted the resource in the chat. But Ryan, tell us about how do you think about hiring people?
Look, I think hiring is one of those things that continues to evolve in terms of what's the best strategy. I think the hiring market's very different now than it was, when I first started out into clean tech. I think it also really comes down to what stage of company you're at. So early on, when in the early stage of startups, I feel like you're really trying to find people that are passionate about the mission and to some extent are generalists, people that can wear a lot of different hats. Because again, when you first start trying to build a company, the roller coaster you go through and the things that come up on a day-to-day basis that you need to solve for, you need people that can take on those different challenges, have that perseverance and get through it. I think as you go transition from there to starting to build out your first plants and your demo or pilot plants, you're starting to now bring in a much broader group of people that can do everything from engineering to operations to now you're building up your marketing and your business development, all the commercial aspects, and bringing in a support team to support that. I think the hard part to me is when you start getting to that phase. I mean, all along you're asking, but when you get to that phase, you're starting to run these plants. When you're going through commissioning, you're asking a lot of these, of your employees, right? So it's trying to find out, trying to figure out how do you staff that the right way, bring enough support and give enough opportunities that you can really keep those people on board. The last thing you want to do is have to keep replacing people or people move on to other opportunities because it is a competitive market. I think the stage we're at now, the hard part to me on bringing people on is that now we're transitioning to commercial rollout. Now you're starting to get into specialized areas. And so you're really starting to look for people that know project finance better than anybody. And, our CFO is for sure that case. But you're trying to find people that really have these core expertise. Like, so whether it be project finance or project engineering or project management, and product management and customer relations, all those types of other aspects are now starting to get very specialized. So I think there's a natural tendency that happens, and it's a learning curve. I think probably all of us keep going through is as you transition to those different phases of the companies, is thinking about how do you have to tool that company, what skill sets do you need in at that point to solve for those different issues. And I think the thing with gene pool engineering is really it's pointing out the risks in the company and making sure that you're finding people to help solve those risks.
Anything you want to add quickly?
Yeah, look, I mean, I think I have a really good HR guy who's worked with my company who basically says, it ultimately comes down to 3 questions. Will you love the job? Will we love working with you? And can you actually do the job? Right. And those are like the 3 questions. If you kind of simplify it down to like, are you going to be the right cultural fit? Are you going to love the job and give it your all? And do you have the right skill sets for the job? And right, like what Ryan said, the early skill sets are like you can do anything, and you're a Swiss Army knife. And later on, you start hiring experts. I mean, I think if you want to find leaders who have staying power, who you can build under, you got to find people with resilience and grit. Because building a clean tech company is like getting punched in the face for the first 10 rounds of a boxing match so you can land a good left hook in round 11. Like that is it. And you want to think about people who you're going to sit in a room and your backs are against the wall and you're trying to figure out what to do, and they're going to perform on that kind of that environment, and you'll be able to share jokes and you'll be able to share a laugh under that kind of level of stress. Somebody who you can enjoy the ride with, but can really sort of stand up to adversity and have resilience in how they handle. I think that's like the book Grit, but that's a book that I think you want to select for grit when you're looking for people who can really be your go-to lieutenants in building a clean tech company.
And maybe just to pick up on that quick, I mean, that is completely that every day you come in, you don't know what's gonna come up next. And I think, for me, those employees that, aren't just going to point out the challenges or the problems, but actually come in with, here's some suggested solutions, or here's things we can do to go after it to fix it. Especially when you just hear the challenge or the bad news, and they're already starting to brainstorm how to fix it. Those are the people you want to anchor around.
Yep.
So you've gone through the ups and downs in fundraising. Particularly, there are times when you may be through the down in fundraising, and some fancy idea that may or may not have merits gets a lot of money in the market, and your employees are wondering whether they should stay with you or go somewhere. Like, have you gone through that kind of a journey where people have wondered, like, why is somebody who's not supposed to be great in technology, or there's no information out there, raising so much money, and what is wrong with our technology? Ryan, what do you think about, how do you work with the team before you live another day to raise?
I'm gonna have to be careful what I say here, because the journeys I've gone through. But I would say, we as a company culture, and I would hope all my employees would say this, is we try and be very open about what we're doing, so people are in the loop on everything, good, bad, where we're going. And I think that that's important, because the more they understand what, the more everyone's aligned and understand what we're trying to do, why this is going to be successful, why our thesis is differentiated, why we have a pathway to getting to, having a meaningful impact on CO2. That's the stuff that I think that we can always then anchor ourselves back around, because you've heard me talk about this before, and I'm not trying to take away from anybody building a company in the space. Building companies is a very hard thing to do, but I'd say every kind of company goes down this road of either building up really their perception bubble or their reality bubble. And I think, it's partly driven by the market, it's partly driven by PR, but there's a lot of people that get a big perception bubble really fast, whether it's of their own doing or not. And so when they're getting a lot of that press out there, it is hard sometimes with your own team to not get down on what you're doing, or think that other people are doing a better job than you, or that they have a better tech than you. And so, again, the more you can refocus around your mission and make sure people understand what it is you're doing and why it's differentiated, that should be able to cut through the noise in terms of what's out there on a perception bubble basis.
Yeah, I mean, the only thing I would add to that is look, like, that stuff comes and goes. You want people aligned with your mission for sure. You also don't want to be in a position where you're begging people to stay who don't believe, and like, that's also a really bad position to be in as a CEO and as a leader. And if people don't see the vision and they're going to start, growing negative. I mean, you don't want blind optimists. You want constructive skeptics, right? But people who want to solve problems. And I mean, people who are going to leave because the company and the industry adjacent just raised a little bit more money, you're better off letting them leave and building a team of people who want to solve the problems in front of them. Honestly, like, I don't think you want to build an internal outreach program that is always, reassuring people and rubbing their backs that what they're doing matters. You want people who understand it and really want to get after it.
And Pete, I wasn't addressing the question to you because you don't seem to have a competitor today.
Yeah. I think we're a company operating in a hype space right now. So, like, but look, like, it's still hard what we're doing. I mean, we're working on, but yeah, we're in a little bit of a hype bubble. I agree. I think Ryan was firing a shot at me.
No.
Maybe last question that's there in everyone's mind. How do you think about different administration and what could happen to the ups and downs of climate? Ryan?
Hey, you or me? Yeah, sure, I can go.
Yeah, you get it first. I'll come in and clean up.
Pete, go for it.
No. So, look, I think this is a hard question to get to. And I mean, I think for us, we have yet to take government funding actually in our journey. So I feel like we're a little bit insulated from some of the challenges that may come depending on what happens going forward. For us, though, the few incentives that we are looking to leverage came in on the prior administration, and then we're doubled down on this administration. So I feel like, there's great incentives out there that are designed to really build the economy, and so hopefully those stay in place and won't hurt us from that perspective. I think the bigger, frankly, challenge relative to the election is purely just timing. I think there's a lot of people that are going to sit back, and we're already seeing this, that are going to sit back, watch, wait, see how things unfold, see how things unfold with the market, see how things unfold with the overall economy before they start making more bets. And so the only thing I'm concerned about, and this is either way from an election perspective, is just what is that stagnated, or that how much stagnated time is there going to be in terms of funding and making decisions on making bets on projects.
Pete?
Yeah, look, I think there's, a lot of people in clean tech, right? The IRA came along and it's created a lot of incentives to take risks that weren't there in the past. And a lot of companies were started before there was any glimmer of hope of an IRA, right? So for a lot of us, that was a little bit just like a bonus, a bonus that was dangled out in front of us. I think some of the IRA tax credits may be at risk. I don't think all of them are. I think there's enough infrastructure being built now based on that it would be a really heavy lift to, regardless of the outcome of the election, to see. So I think the majority of those tax credits will stay in place, and that's the feedback I'm getting from both sides of the aisle. And but look, like generally, if you're in the clean tech business, you've enjoyed stronger support from the Democratic side of the aisle, and I think that's diminishing now. I actually think there's a pretty strong group of moderate Republicans who want to do things that are productive with climate. I think they question sometimes the methods rather than they question the means rather than the end. I do think there's silver lining in if you did have a Republican sweep, which, I mean, it looks like it's a coin toss on the presidency, in the sense that a big thing that people are also working on is permitting reform. And, if you look at where we are today, it's like we got all these great technologies and we can't build any transmission lines, so like permitting reform is really part of addressing climate change. And frankly, I think the red side of the aisle has been a leader in permitting reform. So there are boons and there are losses on both sides. And I think you just have to be aware of that and try to leverage the advantages you have.
Yeah, and from an investor perspective, we've been through this multiple administrations over the last 16 years. I think we're certainly committed, but we'll have to see how the whole thing goes for a lot of other investors as well. Very good. I don't know if we can get any Q&A for the next minute or two, but very much enjoyed the discussion. You guys have been phenomenal in not only building these companies, but every time we reached out to you to help us, help some of the other founders we have in our portfolio and new companies that we look at, you guys have been phenomenal. And, entrepreneurs like you make all the difference, whether US builds these, major investments or not. So really appreciate it. Hey, Ned.
Thank you, Rajesh and Ryan and Pete. That was a great session. We didn't answer too many questions, but I think Rajesh had the questions. So I watched, there was a very nice parallel there between what people were asking in the Q&A and the questions Rajesh was asking. So thank you very much. Wonderful session. Thank you for your time.
Thank you. Very much enjoyed it. Thanks
everyone.
Thanks everyone.